Hello and welcome back to the Retire While You Work podcast. My name is Carson Odom, a wealth advisor here at Adams Wealth Partners, joined by Myles Zueger, another wealth advisor at Adams Wealth Partners, and our guest today, and hopefully a guest that's going to be joining us a lot in the future, Anthony Breen, our newest addition to the team here at Adams Wealth Partners, and portfolio specialist and wealth advisor. We're excited to have him on the team and excited to have you on the podcast.
Yeah, excited to be here and be a part of your guys' team. So
awesome.
It's been good month so far.
Yeah, we're excited to have you.
For sure. It's been, when it comes to the stock market, and that's where we're kind of going to spend time today, is more market focused, looking back over the past, I guess, almost a full 8 months now that we've been here in 2025. On one hand, you could sit here and say, oh, the market's up a little bit for the year. It's been a pretty boring year, but I feel like it's actually been quite the opposite. There's been some drama in the stock market this year. And for listeners, we've got a few slides that we're going to share, just talking high-level overview of the stock market as well as some specific details. But this first slide that I'm sharing is just giving an overview of what the different indices and what the different markets have done throughout the year. So a high level, the overall S&P 500, and this is as of, I believe, August 22nd, the overall total return for the S&P is about 10, little above 10%. And we'll get into it, but it's different just looking at the equal weight. So for those that don't know, the S&P 500 is a cap weighted index. What that means is the bigger the market cap of the company, the larger the weight they're going to make up. So for example, we all hear about the Mag 7, the NVIDIA, Apple, Amazon, Google, Facebook, Tesla. The Mag 7 makes up 35% of the S&P 500 roughly, just because their market cap is so massive, as opposed to your smaller company is going to make up a very, very small portion of it. So this has been a theme we've seen over the past, I don't know how long this has been occurring. Really, this entire decade has been the Mag 7, the overall S&P 500 total return has been outpacing an equal weighted index just because of how strong the Mag 7 comes.
Well, first it was FANG, and then it expanded to the Mag 7. But I think it's still encouraging to see, even though the cap weighted regular S&P is outpacing the equal weight. It's nice to see the equal weight keeping up a little bit closer. I mean, a couple of years ago, it was like those Mag 7 stocks just completely ran away, and maybe they were up 15 or 20%. I think the equal weight was up like 10% or something like that. So at least still trailing by a couple percent, but it's encouraging to see the rest of the 493, as people say, carrying a little bit more weight in the overall index.
Yeah, and the Mag 7 10 years ago was really only 15% of the index, not 35% like it is now.
Which is a trend that you kind of question and ask, is it sustainable? But I feel like as far as the Mag 7 and this extremely heavy at the top, we just keep asking, how long can this last? And it just keeps lasting.
They have had earnings growth that's led to that. Like, there's a reason they're there.
That's right. It's not like a lot of people like to equate it back to the 2000s, the .com bubble, but these companies like NVIDIA, they are absolutely printing cash. I mean, they are dishing out billions of dollars in earnings, and it's not like their stock price reflects the fact that they are earnings. It's not some made up company that is associated with AI and might eventually have $1 of revenue. No, these companies are truly leading the revolution and printing just so much money. Now, is it sustainable at the current pace for the next decade every single year? Probably not. I mean, there's been so much spending, which I'll share that.
So I think, back then in the early 2000s, it was like companies would just say companyname.com, and then people thought they had something to do with the internet, and they probably had nothing. They had nothing to do with the internet. So at least now, Carson, to your point, it's like these companies are legitimate companies. They have earnings. The big question is just, can they continue to grow at the rate that they have been?
Yeah, it's based on revenues, earnings, not eyeballs, like it was in
Correct.
the late 90s.
Mm-hmm.
But yeah, that said, I think 2022 when ChatGPT was released kind of took the data center spending, the CapEx and data center to the next level. I think this chart here that Carson just pulled up really points out how big these CapEx numbers have gotten. I mean, we're talking 4 companies spending $300 billion on data centers. That's, I think our military budget
doubled in 2 years.
Yeah, our military budget is about $700 billion a year. Maybe it's $800 billion by now, but to put that in perspective, so we're basically as much money as we spend on our U.S. military, which, obviously is that defends not just our country, but lots of the whole globe. We're spending that. 4 companies are spending on pace to spend that much money per year in a few years.
Mm-hmm.
Wow.
Which, I remember whenever ChatGPT came out in 2022, and it was obviously kind of groundbreaking. And I remember a lot of discussion about it, but I didn't expect or have the expectation of how much it was going to truly transform everything. And even in, as a professional and even in a personal setting, I underestimated just how much I would be using ChatGPT or chat related, I guess AI,
Like a co-pilot or something like that.
Copilot, yeah, something like that. I didn't realize how much it would replace my traditional Google searches. Like, instead of trying to find, like, I know it's chat. It's chatting. Like, that's its whole function. It's not a Google search where then you have to sort through the results. It's like a chatting feature. You're truly chatting with somebody who's giving you responses in an easy and manageable way, and an easy way to understand. I didn't realize, 90% of my old Google searches are now ChatGPT related or Copilot related. It's completely replaced that. I don't know what it's been for y'all.
I still Google quite a bit, but there is an AI Google.
That's what was my question.
Yeah.
So when you
That's
Google
true.
something, it's like the top part now is an AI summary. How much do you rely on that? Versus
apparently some of the biggest people hit by this change have been, web pages that people used to browse to get an answer. So, like, you used to have to click a link on a web page and you'd be served up some ads, while you look up a recipe or something. And now, since it's just in the AI summary, they don't get that revenue anymore. They don't get those clicks.
That's true. I would think that the Google ad spin would have a pretty negative impact. I don't think they've seen much of a negative impact yet, but I would imagine that as it becomes more normalized through the population, that's going to have a pretty severely negative impact on Google's revenue there.
Well, and the last few years, Google has been the cheapest of the Mag 7 because of these fears, but Google also has Google Cloud, which is benefiting from
other revenue sources,
data center build out. So,
it's
and YouTube and a lot of other things. So,
which on the data center contribution, Anthony, kind of talk through this chart.
Yeah. So this chart in blue shows how much each quarter and each year, really, you can think about it, consumer spending is contributing to economic growth. So we all know the saying that, like, the U.S. is a consumer-led economy. 70% of GDP is, every day people wake up and decide to spend money. If there was ever a day where you pulled into the Costco parking lot and you were the only person there, it'd be a scary day, which I guess really
I couldn't imagine that happening.
I guess that was kind of COVID. That's what made COVID especially scary. But so basically in blue here, you see that in 2025, the instead of contributing a 2% to economic growth, we've slowed down and really only contributing about 1% to economic growth in the last quarter, which shows that consumers are tightening up their wallet. I mean, they're still spending 1% more than they did last year in real dollars. So really that means in nominal dollars, with a 3% inflation rate, they're still spending 4% more than they did the prior year. But it's not 2% above inflation like it was that we were accustomed to. But then the green line, the data centers rollout, has really picked up this year as that CapEx has ramped up. So it's a unique moment where data center, I think this quarter, will contribute as much as consumer spending to economic growth in our country, which is, it is what it is. Just an interesting data point.
Yeah, now I'm curious about how that trend line continues. What's going to be? Are the companies who are spending this massive amount of money on data centers, is the revenue going to sync up essentially on the other end years down the road? But kind of continuing the trend of the S&P 500 being cap weighted, and essentially these mega cap companies making up such a large portion. Like we said, this is since ChatGPT was released, in late 2022? Was that the year when it was, or is that the time when it was officially released?
I remember it was like holiday parties 2022. It was the discussion.
When do both of you feel like you started using it a little bit? Because I'm trying to think. I feel like honestly, I feel like I was more so like last year at some point when I really started using it, maybe late 2023.
You could probably ask ChatGPT, when did I make an account? It would probably tell you. I want to say probably a lot over the past year. I think I might have started using it a couple years ago. So maybe mid 2023 might have been whenever I first started using it. But like we were saying, the amount of earnings that these Mag 7 companies have just skyrocketed ever since then. And you compare it to the other 493 earnings per share. Look at this graph. It is just massive. There's a reason why the Mag 7 are called the Mag 7 and why they make up 35% of the S&P 500. Because look at the earnings here. It's just in a whole nother world. It truly is in a whole nother world.
But that we do think that won't continue forever. But
that's right. That's right. Let's see. I was also gonna. I do like this chart because, ultimately, what drives the stock market is earnings. Stocks go up because they make money, and sometimes it can come to a shock that, especially around COVID, it was really a shock of like, hey, the whole entire economy shut down, but the stock market's making all-time highs. How can this happen? And at the end of the day, it's companies increasing their bottom line over time. So this chart is broken down by sector, but most importantly, I just want to have a view of it as a whole, and basically seeing all the green is depicting surprises to the upside in S&P 500 earnings in Q2 of this year. So essentially, most, if not all, of earnings are out for Q2 of this year. And as you can see, on average, we've seen probably 80-ish% being in line or to the upside outside of materials of companies' earnings being a surprise to the upside. So essentially, they are outperforming what Wall Street has been expecting these companies to perform. So companies are doing so extremely well. Now, that doesn't necessarily mean that there's not issues in the economy or things that you should have, be on high alert about, but companies are making money, and that's why the stock market's going higher.
Yeah, and they're all that data center spend, the idea is eventually the other 493 companies figure out how to be more efficient with their workflows. And I think a lot of companies, the reason last week we got in Jackson Hole that they alluded to the fact that the Federal Reserve Board is in fact open to a few rate cuts here, is because the labor market is definitely starting to show signs of weakness. Mm-hmm. And all that if you think about it, a lot of companies just want to run more efficiently. And I think it would be a weird time to be, a college intern or a new graduate where, the job that you used to have as an analyst or just like a low level white collar job, Chat GPT is starting to replace those roles internally in companies. And so it's just a tricky time. I think over the long run, everyone will be employed. We'll figure out a way to get everyone employed, but there might be some growing pains.
This is encouraging to see, though, because I think sometimes when the market's at all-time highs, people get a little nervous about, they start to not, as a consumer or just as an investor, you maybe start to not feel so good about the economy in general or how the market is. So, but then when you see companies are still profitable and they're more profitable than what people are expecting, it eases or should ease some concerns, I think, on just the overall economy and how people are feeling about things, because the market it has earnings. Companies are doing well, which at the end of the day is what drives the stock market. And so you're still seeing that, even though, your personal opinion may be that the economy isn't doing so well.
Yeah. And I think it's easy to think of the stock market as a whole as just some magic box. So you put money in and hopefully it goes up. But yeah, you can do a bottoms up approach where you go company by company. Okay, this is how much this company is supposed to earn. This is how much this company is supposed to earn, and add that up. So in 2026, I think in total, the bottoms up summation of every single company's contribution to earnings will be $300 earnings per share in 2026. I mean, assuming the economy keeps growing like we expect, and then you just divide that. That's a nice, easy number to divide into the S&P 500. So if it's at 6,600, that would be 22 times earnings. 6,300 would be 21 times earnings. But that's 2026 earnings, though.
Which relative historically, I mean, expensive, cheap. This next chart is the forward price to earnings ratio over the past 10 years. And you could ask yourself, is 22 times, is that expensive? Is that cheap? Where are we at historically? And historically, we're at a pretty expensive point in the stock market. It doesn't necessarily mean just because we're expensive that it's got to come back down tomorrow to its long-term average. And I'm sure if I included even more history, if we included the last 40, 50 years of S&P 500 PE forward ratios, that it would probably be even lower than in this 18, 19, 20 range. Would you agree with that, Anthony?
Yeah. But and the counterfactual that is, the only other time we ran fiscal deficits like we're doing now was in World War II. So we've like just systematically decided to spend more than we take in tax revenues. And what that does is that just basically makes it harder to have a recession. So if you kind of know that it's really unlikely to have a recession given that dynamic and just that tax policy, then suddenly maybe you're willing to pay a little bit higher multiple.
Yeah, that makes sense. I think what also a lot of people forget about, we've had the whole conversation. I'm going to talk about geographic revenue, but let me bring back to where we're at from a return perspective for the overall different markets this year. The top two best performing indices that I've got on this graph are both outside of the US. So we have the MSCI ACWI ex-US. So this is essentially all the other countries in the world as a benchmark, excluding the United States. And then we have the MSCI emerging markets, so the emerging markets index, and both are up 20 and 23% respectively. So we've got countries outside of the US who have essentially doubled our performance for this year. And there's been a lot of good performance. Now, will it continue? Again, that's a question that I don't think we necessarily know the answer to. But what people forget to understand is that being domiciled in the United States doesn't necessarily mean that you're blocked off geographically from participating from these other countries. This graph here shows that almost half of all revenues from US S&P 500 companies are coming from outside of the US. So yes, they're domiciled here in the United States, but their revenue, massive percentage of it is coming elsewhere.
Mm-hmm. Mm-hmm. And yeah, I think NVIDIA has been in the news with trying to get Chinese export bans on some of their GPUs, but those GPUs are still finding a way to get into China, and they're building out. There's kind of I guess an AI arms race, you could call it, for who can have the best model, I guess. But all that does is increase NVIDIA's bottom line.
But I mean, this does go to show whether, even for those who think, oh, I only invest in U.S. companies. Well, if you're invested in only U.S. companies, I mean, 40% of that revenue is still coming from international companies. So it's, you have diversification across the globe, whether you realize it or not. But I still think it's prudent to look at international as a piece of your portfolio if you're just going to be a well-diversified investor anyways.
Yeah, and the euro has strengthened this year, which actually helps when you convert those earnings back, the earning power. Like say someone buys a Taylor Swift song in Europe. If they're buying them in euros, I don't think they change the price of the Taylor Swift song every day based on the prevailing rate. I think it's probably just €1 per song. I've not researched this thoroughly enough to know, but I'm pretty sure it's €1 per song if they're doing the iTunes model.
I was going to say, has there been inflation on iTunes? Because it used to just be 99 cents for
I guess it's all about
it might be $1.29 on stuff. I mean, I haven't bought a single iTunes song in 20 years, but
let's just say for the argument, €1 spent, and when the euro is 120, if there's a 10% margin on that song, then instead of making 10 cents on that purchase, someone's making 12 cents for the US company when the euro goes up. So
that makes sense. The last kind of topic I want to talk about is, we hinted at it earlier, but essentially you have the stock markets at all-time highs, but as a consumer, it can feel like things are a lot worse than what the stock market might depict. And a part of that, and I think a large contribution to that, comes into housing. We have a housing issue here in the United States. In other countries, it's worse, believe it or not, but at least here in the United States, it is a very big issue. What this chart essentially depicts is the average median home price compared to the income that you need to have the ability to afford that home. And right now, there is a 57% affordability gap, meaning you need to make so much higher of an income in order to afford the average median home. And that's a massive issue. It's a combination of homes appreciated ever since COVID, a very, very large amount very quickly, and incomes did not appreciate that quickly. And then B, another driving factor of that is interest rates. We've had, one of the fastest rate hiking cycles in history back in 2022, which has led to mortgage rates being extremely sticky around 7.5% these days.
Like they've been between that 6.5 to 7 range for the better part of a couple of years.
I think we just broke below 6.5 last Friday on the Fed cut news, but still when you do 6.5 or 6.25 on $1 million house, that's a lot of interest.
Yeah, it is. A lot of interest and very expensive, especially compared to if your income hasn't kept up and it's appreciated a little bit over the past 5 years, there's no way it's kept up to how fast home prices have appreciated. So it's just a very big issue. It takes the other graph that I wanted to share was the median housing payment as a percentage of median income. We're at almost 50% of your income that's needed to afford to make the housing payment for your average home. I mean, that's crazy.
I didn't think of sending you this chart, but I have this stat on my head that's relevant. I think it came out the average age of a home buyer in the United States is 54 years old. So
54. Wow.
Yeah, that's the average. So, and 20 years ago it was like 34. So I think you can't lock out people in their 20s and 30s from purchasing a home forever before some unrest.
An entire generation.
Yeah. So I think they won't be locked out forever, we hope. Yeah.
That's right. So, I mean, what's the solution? I mean, on one hand, interest rates could come down. So we could have interest rates come down, which makes that monthly payment decrease, but you're still dealing with homes that are so expensive. I mean, I think around here in Nashville, your probably starter home is what? $600,000. Maybe you can get a condo or townhome. Can you even get a condo or townhome for $500,000 or $600,000?
Yeah, there's some. I live in the I mean, for those that know Nashville, I live in the Nations. There's some condos for sale for like 250, 300-ish. But I mean, they're not big. They're like a 700 square foot condo. They're not that's not like a 3-bed, two bath, 2,000 square foot condo. It's like a 1-bedroom apartment, basically.
But then you still got to afford the monthly payment. So I don't know what the monthly payment on a 7% interest rate, put your 3% down for, your FHA loan, then you're probably paying more than what you could get in an apartment. That's probably bigger.
I mean, to me, it does feel like if, they cut rates and you're sitting here, I don't know, midsummer 2026, and maybe rates are down, if the Fed funds rate is down 1% or so. So you're somewhere between 3 and 3.5 on that. It does feel like that should, I mean, if mortgages, we're at 5 to 5.5 versus 6.5 to 6
7,
right now, 7.
It would help a little bit.
It feels like that should help a little bit to me, but you also never know. I mean,
Still need to build tens of thousands of homes here in Nashville, but that's part of the.
I just don't. I don't feel like you're going to see that price depreciation on homes. There's so much demand here in Nashville, especially kind of being secluded. If we just talk about here in Nashville, yes, I know it's been sticky as far as movement and prices. Probably over the past year, there probably hasn't been a ton of appreciation, hadn't been a ton of depreciation. Probably around the same over the past year or so. But I don't necessarily see a driving force of sending home prices lower. I mean, you truly have to have a massive recession like we had in late 2000s with the financial crisis, or just a massive increase in supply. And we've been undersupplied for 15 years.
Yeah. And the cost of building a home has gone up a lot too. So it's not like the home builders can just show up and get 100 acres and put up 1,000 homes, or I guess they'd only put up, that'd be a pretty tight housing committee, 0.1 homes, 0.1 acres.
A couple hundred homes, whatever.
Yeah, a couple hundred homes. Yeah. Or 400 homes, quarter acre lots. For them to build a $500K home is really difficult these days, because
I've also seen
and just lumber and labor. I mean, everything's gone up.
On top of that, I'm not going to quote this stat, but I know average home size has also dramatically increased over the past 40 years. So used to, your average home might have been, I don't know, 12 or 1300 square feet. And I think now the average new home construction is around the 2,500 square foot perspective. So yes, the price is a lot more for that your first time home, but you're also getting a lot bigger house just as far as overall square footage goes. So yes, it's more expensive, but nobody's building 1,200 square foot homes anymore.
Yeah, the 1,200 square foot, it means you're in a condo now.
Yeah, like my first home was 13 or 1,400 square foot. It was a 3-bedroom, 2.5 bath, and it was perfect. Like I couldn't have dreamed of a better first home. It was like on a half acre. Now it was in Smyrna, so it was outside of the city, but it was like a perfect first home because we could have, we moved before our first daughter was born, but we could have started our family there and everything. I mean, it was a perfect size. It's just now any new neighborhood, I don't know if there's anything less than 2,000 square foot for a home, standalone home. But just contributing to the issue. But what else? Anything else from y'all's on market or economy?
No, I think this was good stuff to go over. I feel like we need to start doing these market update ones a little bit more often. It's just good to get some charts out, I think, to clients and just let them know what we're thinking about, what we're seeing, what's kind of, what we're forecasting and where our thoughts are at when it comes to the markets and economy and what we're seeing. I mean, we're fortunate to be able to have conversations with people smarter than us at some big firms. And now we've got Anthony on the team to help go over some of this kind of stuff and help us make sense of it in a little bit more complex way, but also simplify it to where it's easy for people to understand. So it's, I feel like this was a good episode, just kind of recapping things as we close out this summer here. And Anthony, thanks for joining us on your first one.
Really excited to join you guys and look forward to joining fairly regularly.
Well, thanks for joining us on another episode of the Retire While You Work podcast, and we'll see you next week. All right.
Any opinions are those of myself and not necessarily those of Raymond James. Expressions of opinion are as of this date and are subject to change without notice. The information contained in these podcasts do not purport to be a complete description of the securities market or developments referred to in this material. The information has been obtained from sources considered to be reliable, but we do not guarantee that the foregoing material is accurate or complete. Every investor situation is unique, and you should consider your investment goals, risk tolerance, and time horizon before making any investment. Prior to making an investment decision, please consult with your financial advisor about your individual situation. Any hypothetical examples are for illustration purposes only. Actual investor results will vary. Raymond James does not provide legal or tax services. Please discuss these matters with the appropriate professional.